Here's a shocking fact for you. Over 60% of new property investors make critical mistakes in their first year. And most of them, they don't even realise it until it's too late. The truth is, the difference between making money in property and losing it comes down to knowing the right playbook. But here's the thing, this isn't about simply saving for a deposit or getting the best deal on a mortgage. It's not about location, flipping houses or fancy renovation projects. Those are the basics. What I'm going to share today are the strategies that no one else is talking about. The real insider moves that separate the amateurs from the pros. So if you're serious about property investment, whether you've got £1,000 or even £100,000, then stay with me, because this is the playbook that you need to know. If that sounds good? Do me a favor, hit that subscribe button. Now let's get into it.
Chapter 1. Why property investment? First things first, why property? Unlike stocks and crypto, property is a physical asset. It provides cash flow, appreciates in value over time, and can be leveraged. In simple terms, it's one of the safest and most powerful ways to build wealth, but only if you do it right. One of the biggest advantages is leverage. Property allows you to use a relatively small amount of money to control a much larger asset. If you have 25k, you could use that as a deposit to buy a 100k property. If the property increases in value by 5%, you gain 5 grand. That's on the total property value, not just your deposit. This means higher returns compared to investing the same 25k in stocks. However, leverage also comes with risks. If the property values drop or you overextend yourself financially, you could find yourself in negative equity. Additionally, property provides multiple income streams. Rental income provides cash flow, while appreciation increases your wealth over time. There are also tax benefits, such as mortgage interest relief and deductions for expenses, which can enhance your returns. However, property isn't a get-rich-quick scheme. Market conditions, tenant demand, and financial costs all play a crucial role in determining success. Investing without understanding these factors can lead to costly mistakes. Chapter 2. The different ways to invest in property. Property investment isn't just about buying a house and renting it out. Here are the main ways you can invest. Buy to let. This involves purchasing a property and renting it out to tenants. While it provides steady income, it requires strong tenant demand, proper property management, and an understanding of landlord responsibilities. Choosing the wrong area or property type can result in low occupancy rates and financial losses. Flipping. This strategy involves buying a property at a low price, refurbishing it, and selling it for a profit. The key to successful flipping is purchasing below market value and keeping renovation costs under control. However, unexpected repair costs, market downturns, and delays in selling can reduce profits and lead to losses. HMOs, or houses of multiple occupation. This involves renting a single property to multiple tenants, often boosting rental income compared to standard buy-to-lets. However, it requires compliance with strict regulations, higher maintenance costs, and more active management. REITs, or real estate investment trusts. This is a hands-off approach to property investment, where you invest in a company that owns income-generating real estate. While it offers lower entry barriers and diversification, returns are generally lower than direct property ownership. Serviced accommodation. Short-term rentals, often through platforms like Airbnb, can generate high income. However, seasonality, high maintenance, and potential regulatory changes pose risks. Chapter 3. How to find a profitable deal. Buying the right property at the right price is everything, and here's how to do it. First off, research the market. Look at historical price trends, rental yields, and employment data in the area. High growth areas with strong rental demand tend to offer the best long-term returns. Look for below market deals. Motivated sellers, auctions, and off-market properties often offer great discounts. However, purchasing in distressed sales requires thorough due diligence to avoid costly surprises. Check rental demand. Ensure there is sufficient demand for rental properties in your chosen area. Vacancy periods can quickly erode profits, so proximity to transport links, universities, and job hubs is crucial. Run the numbers. Calculate expected rental income against costs such as mortgage payments, maintenance, insurance, and management fees. If the numbers don't make sense, it's best to walk away. Chapter 4. Common mistakes to avoid. Now let's talk about the mistakes that can ruin your property investment journey. Not doing proper research or buying based on emotion rather than data. Always be sure to check local market trends, rental demand, and area development plans. Over-leveraging. Borrowing too much can backfire, especially if interest rates rise. High mortgage costs can eat into profits and increase financial stress. Ignoring maintenance costs. Unexpected repairs can quickly drain rental income. Setting aside an emergency fund is essential for long-term stability. Choosing the wrong tenants. Poor tenant selection can lead to missed rent payments and property damage. Tenant screening, proper referencing, and property management help mitigate this risk. Failing to plan an exit strategy. Markets change and you need to be prepared. So have a plan for when to sell, refinance, or shift strategies if necessary. Chapter 5. How to finance your investment. Not everyone has 100k sitting in their bank account, but that doesn't mean you can't invest. Here are the ways to finance your property. Mortgages. Standard buy-to-let mortgages require deposits, usually around 25%. Understanding interest rates and loan terms is crucial. Bridging loans. These are short-term loans designed for quick deals, flips, or property refurbishments. However, they come with higher interest rates and require a clear exit strategy. Joint ventures. This is partnering with an investor who provides the capital while you handle the investment process. Clear agreements and aligned goals are essential. Rent-to-rent and lease options. These strategies allow you to control property without actually owning it, often generating cash flow with little upfront capital. Angel investors and crowdfunding. Securing funding from individuals or groups willing to back profitable property deals. However, presenting a strong business case and clear returns is crucial. Chapter 6. How to protect your investment. Protecting your investment is just as important as acquiring it. Here's what you need to know. Get the right insurance. Landlord insurance covers property damage, loss of rental income, and liability claims. Some policies even cover tenants' defaults, protecting you from missed rental payments. Set up strong agreements. Having a legally sound tenancy agreement ensures that both parties understand their rights and responsibilities. A well-drafted contract can prevent disputes and protect your investment. Routine maintenance. Regular inspections and prompt repairs help maintain property value and tenant satisfaction. A neglected property can lead to higher turnover, costly repairs, and even legal issues. Tenant screening. Choosing the right tenant reduces the risk of non-payment, property damage, and legal troubles. Proper referencing, credit checks, and rental history verification are essential steps. Chapter 7. Scaling your property portfolio. Once you've got your first property, here's how to grow your empire. Leverage equity. If your property has appreciated in value, you can remortgage to release equity for your next investment. This allows you to extend your portfolio without needing large cash reserves. Diversify your strategy. Consider mixing different property types such as buy-to-let, HMOs, and serviced accommodation to spread risk and maximize income. Use joint ventures. Partnering with other investors can provide additional capital and expertise. This is a great way to scale up faster without overextending yourself financially. Automate management. Hiring property managers, using technology for tenant communication, and outsourcing maintenance can free up your time while keeping your investments running smoothly. Chapter 8. The future of property investments. The property market is evolving. Here's what to expect in the coming years. AI and big data. Technology is revolutionizing property investment, from AI-driven valuations to predictive market trends. Smart investors will leverage data to make better decisions. Sustainability and green investments. Energy-efficient homes and eco-friendly developments are becoming more popular, driven by government incentives and tenant demand. Properties with high EPC ratings will likely outperform in the future. Regulatory changes. Laws around short-term rentals, tenant rights, and taxation continue to evolve. Staying informed on policy changes will be critical to long-term success. Global market shifts. Economic conditions, interest rates, and political changes can all impact property values. Keeping an eye on the macroeconomic trends will help investors adapt and thrive. So, there you have it, the ultimate property investment playbook. Whether you're just starting out or looking to scale your portfolio, understanding these strategies and avoiding common mistakes will put you ahead of the game. If you found this video useful, hit that like and subscribe button. I'll catch you on the next one.